Hey everyone, it's Imran back again with another macro options spotlight. All right, debt ceiling negotiations saw no breakthrough. Surprise, surprise, from yesterday's meeting. We did say that this thing's not going to get agreed until the last minute, and so stocks remained heavy. We do think expiry though is holding the large cap indices up right now. If you look at the likes of Russell, that did manage to fall 1.5%, but Nasdaq and S&P just couldn't do a lot. And we think it's because of this kind of dealer gamma that's a bit sticky that's holding markets here. Commodities were under pressure though. You can see that data from China continues to disappoint on the manufacturing side, and then the dollar obviously showing a bit of strength, which typically isn't really a thing that commodities like too much, right? So that was what we're seeing there. In terms of volatility, we saw an uptick in vol in S&P and Russell, about a vol point apiece. Asia also seeing 3/4 of a vol uptick. But Europe just can't do anything. Europe's kind of just not moving, literally less than sort of 10 basis points, and vols just can't get going there, right? So Europe definitely looks more pinned, even more than S&P. Commodity vols firming up a little. We're seeing precious metal vol firm up, silver, GDX, oil, all seeing a little bid there. Copper's doing quite well as well, having another 2% down move. That's 6% week on week, and that vol has had a reasonable bounce on the week, up 3 vols. So you can see that there. Looking at carry, back in the green for a lot of these names in equities. Europe's the best one, obviously, because that thing just can't move, even though we've got low implied vol levels there. And obviously, we had a bit of a bounce in implieds in US, and with the market pinned around these levels and really unable to break either way, it makes sense to see some green coming back on the carry board. FXI was the only index there in negative carry, realizing around 35 versus implieds at 28. Looking over at commodities, a mixed bag. We are seeing the likes of gold, GDX, oil, and nat gas in positive, whereas silver's moving a bit more, uranium's moving a bit more, and copper is in neutral. Uranium's now down 4% on the week after we flagged to buy Cameco puts last week. That trade's actually done pretty well. That stock's down about $2 from its most recent high. Okay, looking over at a few things I'm looking at. Concerned about crowded trades, right? So we thought gold was feeling very crowded. Obviously had another push up at all-time highs and failed there. But, the whole world and their dog is bullish gold right now. We've had a consensus bearish view forming on the dollar. We've had safe haven flows around the debt ceiling, where gold has shown past precedent to do well in a debt ceiling debacle. So all these things have kind of led speculators to be piling into gold to play that breakout, but they were once again disappointed. And we literally just saw gold pop back down below 2,000. So we are seeing potentially a bit of a positioning flush out going on in gold. Who knows how low it can go? We do have some moving average support approaching here, but I wouldn't even be surprised to see 1950 or even a little bit lower. We look at some Fibonacci confluence levels. Maybe we can get down closer to 19 to 1920 area. Now, if we did manage to shake out some weak positioning and get down there, we do think owning some longer dated call spreads is probably a decent trade. To just own that longer term structural uptrend, which we do believe in. But we just thought positioning again got a bit frothy. That ultimate break of those all-time highs probably does happen. And when it happens, we're going to get a nice move higher. But we just don't think it happens when everyone's positioned for it, right? So that's kind of the thing you need to try and look out for, and just use these dips to get back into the gold trade, right, on those longer term positions. Another potential fragility or crowded trade that we think might be forming, if we look at the stellar performance of vol selling so far this year, and particularly in the last couple of months, data from Nomura shows pretty good returns here from selling daily options. Obviously, we know the zero DTE crowd has been suppressing vol by selling these options and then buying them back at the end of the day, things like that. And given the track record that these have had this year, we think more and more money is going to be chasing these type of strategies. And so whilst they've produced good returns so far, when too many people start to do it, then that risk premium gets shrunk back down to very low levels. You can see that from the one-day VIX trading at like 11 or something. And we think things can maybe get explosive if too many people have got these trades on. So let's not forget, vol is generally a mean reverting asset. And so it just isn't going to just keep going down, down, down forever. And with the amount of uncertainty we have around the economy, around the debt ceiling, all these things, inflation even, I mean, I think it's getting to the point where it might be a bit crowded and there might be a pain trade forming there. Okay, locally, clearly the street owns enough gamma from this vol selling that in the absence of any news flow, markets just sit here and do nothing. But if you can get enough news flow and enough actual real selling of equities to move the market away from this local gamma, then all of a sudden you could start to get a bit more explosive and see things happening. Okay, and we're seeing a structural bid in skew, we're seeing a bid in VIX upside and things like that, and these kind of things can fuel that type of move. Okay, so on that point, looking at S&P, what happens? I had a conversation with Brent Kachuba over at Spot Gamma yesterday on YouTube Live. We were talking about what happens once the S&P pin gets pulled. Okay, we have these expiry discussions pretty much every Tuesday before the monthly expiry, so it's once a month where we shoot the shit about the market and where we think things are headed and what we're observing in options markets. You know, he's always a good person to bounce off from that perspective. So, you know, we've obviously been stuck in a tight range on S&P, call it 4150 on S&P or 412 has been a big level on SPY. There's a massive strike with a lot of gamma on it around that level. So it looks unlikely that we're going to really move materially away from here before Friday rolls off. And those SPY options will roll off on close on Friday, those 412 strikes, but they've got a chunk of gamma on them. You can see here, it's the biggest gamma strike and it's pretty significant on Spot Gamma's sort of map that they have here for open interest. Now, given the debt ceiling standoff, how it's been impacting the CDS rates, and the recent bounce in the dollar, we wouldn't be surprised if the S&P does need to trade a bit lower into the end of the month, as a resolution is unlikely to happen until the 11th hour. Okay. Now, dealer gamma positioning on the S&P and the SPY and the SPX is going to be far reduced after this week, and that's going to free markets to move up a bit more. You know, as we get closer to until we then get into that June expiration cycle. Okay, so we saw that happen last time round, where the market had a little drop after the last expiry and then chopped around for a couple of weeks and then settled down again. So we think potential for that to happen again, and then you've also got the catalyst of the debt ceiling noise, which might make things look a little bit uglier. Okay. Now, implied vols have obviously been getting crushed with all the super low realized. Skew and convexity have remained bid. So investors are clearly aware of this downside tail. So we would look for ways to take advantage of the richness in skew to play a modest move lower in markets, right? We're not looking for a massive crackdown. You know, 380 would be a proper stretch, I think, on the S&P, given the way it's trading. But anywhere between 400 and 380 on SPY is a kind of moderate type sell-off that we think we could capture, and we can take advantage of the expensive skew to do it, basically. So how are we going to do that? So if we look at the dashboard, obviously the dashboard just says that vol is relatively cheap. But if you look at carry, clearly carry is still positive. So we've got vol carry here. So you don't necessarily just want to own a load of outright puts. You can also see here that whilst the very front end is actually very low at 13, the curve is quite steep. So again, be a bit wary to buy too much vol because it's got quite a steep roll down on that term structure. So that's something you need to be aware of when buying options that are maybe 2-3 months out, things like that. But the thing that is clearly standing out is the elevated skew, right? We've seen skew go back from like a 4 handle back to a 6 handle, and that is in the 70th percentile and looking relatively expensive, right, in the 1 month expiry. So the way we would capitalize, take advantage of that, is we would do a put condor. All right, that is a trade idea for today. Thanks for listening. Catch you all tomorrow. Cheers.